Good morning, everyone. As Emily said, I'm Chief Growth Officer at Dash, and I lead our strategic initiatives and go-to-market strategy in terms of how we provide our solutions and services to advisors, practices, and licensees, but not in a way that just aligns to best practices as we see around the globe, but most importantly for what is unique and personal to your advice business. So thank you for your time. I know it's a precious commodity at the moment, and so we're going to try and make today as meaningful as possible for you. I wanted to touch on just for a minute or so as to why is Dash leading this conversation with the IMAP team and Toby. To put it simply, the purpose that we exist is about empowering advice practice success. Everything we do is about trying to work with advice businesses to increase their scale, enhance efficiencies, and accelerate growth. We believe that the advice businesses deserve not just a technology provider, but actually deserve a business partner that actually understands technology and understands the complexities of running a modern advice business to help you build the business of the future. And that's a good segue into the managed account framework, because managed accounts started off as an investment solution a very, very, very long time ago, and they've now become part of the strategic architecture of an advice business. Now, with that architecture comes a lot of questions at the moment in the current environment. And as Toby mentioned, you've heard a lot of speakers today, and no doubt those messages came across. What is the right operating model going forward? Should investment management be part of my value proposition going forward? How do I strengthen my governance framework in this environment that we're in? All very, very good questions. But the key thing is that how you approach them is very, very important. And typically, in the past, the industry has approached them from a product perspective rather than actually understanding the business. Where does it want to go? What are the clients it wants to serve? And the business it wants to become. So in terms of what I'm going to cover today, there are probably three distinct sections. Firstly, I'm going to look at the evolving landscape, looking in the rearview mirror and looking into the future. And off that evolving landscape, we're going to also look at, well, what are the thoughtful decisions that as business owners you can take as you guide your advice business in the coming environment to ensure that you're absolutely able to empower the end investor and investment outcomes are what you want them to be. But at the same time, you're able to build an advice business that is efficient, stronger, and increases the enterprise value. And then the final section is going to be hopefully some practical insights and takeaways that you can take away from today to apply to your business. And one thing I'd say is that those insights are a presentation all to itself. So we're obviously happy to engage at a later point on them. So I said I'd look into the rearview mirror. And what people don't often realize is that managed accounts, like me, are well over 50 years old. And they were actually invented in the 1970s. Now, in the 1970s, there were two distinct markets that existed in the investment landscape. There were institutional investors on one side, pension funds, endowment, insurance companies, who had access to a wide opportunity set of investment products, plus significant investment capabilities to build portfolios. On the other side were individual investors, predominantly in those days sitting in pooled managed funds, and a very, very narrow opportunity set of what they could access. At best, they could probably go to a broker to buy stocks and shares. And it's this distinct gap that was what managed accounts set out to solve. How can one take to the individual investor a wider access to investment opportunity sets, and at the same time apply institutional grade investing capabilities? And that was how it all started. Now, the one thing you heard me say so far, not a single one of those reasons that managed accounts were invented was for advice business efficiency. Not one. But it's all about the end investor and what one could do for them. So if you look at the 5 areas on the slide at the moment, direct ownership, transparency, all these things that you see are exactly like today. The world hasn't changed 50 years on. Professional portfolio management, by that institutional grade investing capabilities to the end investor. Personalization, the preferences, values of what is important for your end clients could be transferred through the portfolios. Being able to better precisely managing tax and gains for tax. And then consistency and risk management. And by that we mean systematic rebalancing versus sporadic trading decisions taking place. So the two probably key points I want to make at this stage of this journey. Step one, it wasn't all beautiful in the management account space at this point in time. They were very expensive and highly operationally intensive in the 70s and even going into the 90s. And it was only really affluent investors, and I know you heard sort of the family office space a bit earlier today, but it was only really affluent investors that were able to access them. It wasn't the broader investor universe. The second thing to call out is that from a investment perspective, it is all about absolutely trying to get those investment capabilities to those institutional grade investment capabilities, empowering investor success. It was not about the business. And with that in mind, leading on to the next era, again, it was about the investor, the end investor, and benefiting them. At this stage, though, it was actually about investing implementation. So if you think about it, you've got portfolios that are really well constructed with very smart investment folks, but then the implementation of those portfolios was well behind. And by that I mean, it is how do you go to the individual investor and give them the portfolio you actually promised them? And also, how do you ensure that there's no implementation leakage on the portfolio? Reduce implementation leakage, so they actually got the return they deserve. So it was about improving governance implementation. There were three stages that this occurred. Firstly, the formalization of the ASIC MDA defined the licensing, disclosure, and governance framework in the early 2000s. By the mid-2000s, we had standardization of portfolios. Just remember, at that point in time, you had a lot of advisor-by-advisor managed account structures. Moving to a centrally based structure. But it was the industrialization that really was the next lever in the managed account space. And by that, trade, custody, data, platform, technology improved significantly so that the speed of decisions and precision of those decisions meant hundreds of portfolios could be updated at the same time. And the benefit for the end investor of those industrialization was consistent outcomes, systematic rebalancing could take place, as I mentioned, prompt implementation, and a governance trail as to what decisions are made, why and when, and how. But it was actually the end of that sort of era of the industrialization when for the first time, advice for business efficiency reared its head that could be achieved. And was mainly due to the ability at that point in time to actually go execute managed account decisions. So if the first era of managed accounts, if you think about the promise that was given to the end investor, one, at this point in time, that institutional grade investment capabilities, that access to a wide investment opportunity set, and actually the portfolio that was built for them meant it could actually be executed and achieved. The next era was one where it moved away from the investment solution transformation to what became a business transformation. And the business transformation was all about how do you ensure you get yourself an efficient, strong, and increased enterprise value of the business. And there were two big catalysts that caused this to happen. Firstly, FOFA, Future Financial Advice. So it was probably 2014, if my recollection to 13, it serves me right, where that came into play. And then obviously the Royal Commission. And these were two significant catalysts that led to the huge and massive adoption of managed accounts. Now, not only did this increase compliance costs, and Toby touched on some of the but the changes that are occurring from a regulatory perspective as we look ahead. Not only did it increase client costs, it actually changed the whole economics of advice businesses. The cost of delivering advice, time increased enormously. Professional indemnity, licensing costs, everything went through the roof. Falling advisors meant those poor advisors now had to look after more clients with less resources and costs. So to just survive in this environment, a business model had to change. And some took on the managed account space to thrive. Those that increased scale, enhanced efficiency, accelerated growth, really embraced managed accounts. And that is what led to the enormous adoption. So I said I'd go through the past because it does influence the direction we're going in the future. Because if you've got this history, it was all about the end investor, but yet, funny, the adoption of managed accounts didn't happen for the end investor. It happened when the business issues arose. So we're at this inflection point, and I know you heard from Andrew this morning and Francie, and no doubt regulations covered a huge part of your day already. So I'm not going to go into that, but I think there are some key so whats that have come out of this that will certainly influence the future direction of what you do in terms of building the model. Firstly, regulation used to shape the way products were designed. Not used to, probably still does, but right now they're actually influencing platform behavior more than product design. And by platform behavior, there are two key trends that have come through. Firstly, platforms are becoming way more selective in what they do. Accountability on trustees, REs, licensees, who have I left out? Platforms, is enormous. And off the back of that, they've been far more selective about what stays on the platform and what doesn't. Now, advisors and advice businesses might be accusing platforms of being not innovative or not advisor-friendly, but the reality of it all is that the barrier to entry, if you want to go set up a managed account, is much higher. The hurdles are much, much, much higher. If you've already got a portfolio, the ability for that to stay on the platform is also going to be much higher. No more is it a case of, well, can we administer this portfolio on the platform? It's actually about, can we defend it with the increasing regulatory sort of focus on the end investor. The second trend, which really has come off the back of the platforms being more selective, is what we call the institutionalization of investment management. What we've seen is platforms focus mainly on the large institutions in terms of that greater hurdle to actually allow portfolios to be run. We've obviously had a significant growth in managed account adoption. Off the back of that, it became the boutique niche asset consultants in the industry. It's been harder for them to work with the platforms because the platform's looking at significantly resourced providers. The second one is that performance matters more than ever. It has to be evidenced, and it can't just be a narrative anymore. And there's a part of me at times, and Toby and I were chatting a couple of weeks ago, it almost reminds me a bit of my super days, like the portfolios all had to just sit in the middle and all be very benchmark aware and roughly around about the same, is that now, if you're significantly underperforming, it's going to be very hard to be able to justify, even in a certain market cycle. So tracking error to peers is going to be something to be aware of. But those are two sort of, as I said, key so what's out the regulation that certainly impacts how you run and take your managed account structure going forward. The third one, which again, everything being focused on the end investor as the regulations have come in, is in the world of SMA and MDA, and Toby touched on that a little earlier before I spoke. But in essence, again, preaching to converted, I know you all know this, SMA is a product, there's a PDS, and it's governed as a managed investment scheme. MDA, an advice-based service with an asset relief and an agreed investment program with the end client. The MDA does provide greater flexibility, the ability to have direct ownership and personalization, and discretionary implementation. It's not one or the other. Both are professionally managed. Very, very important from an investment perspective. But with the direction coming through, we should know sort of October, the direction of where that review is taking place, and maybe even as early as September. As I discuss the view going forward of how we see things, it's not going to be a case of these are the absolutely concrete facts. It's our direction where we feel the industry is going and what we think if you want to build the business of the future, you need to be doing. So on one side of the spectrum, if you look at the industry today, we've got a number of vast businesses around the country who have had managed accounts set up as potentially SMAs, 3-4 risk profiles rolled out across 125 clients. That's on one extreme, all governed by a PDS and a product. On the other extreme, you've got complete unconstrained MDA structures built. Everyone's got a different portfolio. How do you manage that? Those are the two extremes. Where we believe the industry is going is in the middle. And something that we have coined, and I'm no marketer, but trying to work out, is governed personalization. That's where we feel the industry is going. of this, in that middle ground. And let me touch on a little bit detail what I mean by that. Governed personalization effectively means that you've got institutional grade governance around your managed account structure. At the same time, you've got the ability and flexibility where required and for the needs of the end investor to personalize it to their circumstances. Stressing again, it is not unconstrained customization. That's not what it's about. And when one looks at what I've just said now, if you look at the purest, the previous table covered the MDA structures. If you look at the MDA in its purest form, not the way potentially it's been used over the last 25 years, but in its purest form, provides the architecture to achieve just that. The value for clients of governed personalization. Each portfolio is built around each client's goals. Very, very important. Existing holdings, tax positions can all be accommodated for the end investor. And at the end of the day, the client signs every year on a new investment program versus going into a PDS, into an SMA, and sitting there for a few years. And the solution adapts to the client, not the client trying to fit into this model, those 3 risk profile type SMAs I mentioned earlier. The value for advice businesses, where you get institutional governance across one consistent investment architecture. Still got the governance involved. Discretion, in terms of the implementation, means the ability to actually exercise that portfolio within the parameters that's been given, and consistency in advisor capacity is preserved. One repeatable proposition as you go out to market across your advisor base. Now, there's 2 key points I want to touch on and discuss in a little bit more detail about what's on the screen. More flexibility requires greater responsibility. Greater responsibility means greater, stronger governance is absolutely crucial in this future world that we're going to. That's point number 1. Point number 2 is that I've been hitting the road again. I was not on the road for a while seeing advice businesses, but I am these days. And last week I was in the Gold Coast, and one advisor said to me, which one's better, MDA or SMA? And the short answer is that's the wrong question. The right question is, for my business and my different client segments that I serve to achieve their needs, goals, and aspirations, which is the right vehicle to get them to achieve those? And within that question, the definition of a vehicle is exactly what I mean for the legal structures of an MDA and SMA. One is not better than the other one. It just depends on what is for the right segment and what those clients specifically need, which is super important. So what do we see the future looking like as we work with advice businesses and as in the last few years I've been lucky enough to travel around the globe and look at what in the US and what others are doing, is that we see an advice business analyzing its client segment. And as I said, an MDA in its purest version gives you governed personalization, but there will be absolutely client segments that will not fit into, won't want personalization, certainly won't need it. But it's making sure you're working through your clients and making sure that the solution aligns to that. So it's actually a combination of both is the operating model going forward, because they are just vehicles. That's all they are to achieve those needs and goals. Okay, so that's the second part of the presentation I wanted to touch on. So we've covered the inflection point. We've covered where we feel sort of governed personalization's going ahead. How does one look at sort of the next stage, which is more about when the rubber hits the road and working with advice businesses? Governed personalization we see is in the evolution and that really 4th era of the managed account growth. So the next 10 years we think is going to be sort of driven by the structures I've just touched on. Now, with disruption comes opportunity. Regulatory shifts, technology shifts like AI and various other things that are coming in right now, that causes existing business models existing businesses to question and look at how they're running their business, and it causes disruption in their business, and that creates opportunities along the way for you with your clients and as you grow your advice business. So what are the 5 priorities that a practice can take from this analysis of their business to strategic action? Firstly, review your managed account strategy. That's obvious. If you've got one already, review it. But don't review it from a product perspective. Review it from a strategy and your business. Very, very, very important. What is the business you want to run and what do you want it to look like? Because then that determines the vehicles. Assess concentration risk. If you've got 4 existing managed accounts, what happens if a platform comes to you and says the performance of that model is not good enough and it's got to be taken off the platform? How do you run your business? These are the things you need to be thinking about as you look ahead. Strengthen governance. I can't stress enough. I'm sure I remember there was research done about 25 years ago into what governance added to overall value to end clients. And I think there'll be time, I think with the huge focus on governance going forward, I think there'll be more research like that coming out. Educate advisors. As I've traveled around the industry, I'm still quite surprised how little advisors actually understand MDAs. They know the acronyms, and SMAs they can probably fathom because it's like it's a product, and they deal with products for the last 25, 30 years in their businesses. But the nuances of MDA and what they actually do and how you can operate them are very, very limited. So hopefully Toby's sessions at the end of the year can help that. Think strategically, not tactically, and that links on to the next question, which I really opened with. Don't think which platform. That's not the answer. It's what operating model do you want to support the next stage of my business growth? And that really frames the conversation. So for us, when the successful advice businesses of the future that we see sort of not just surviving, but really thriving at the future, and really in this 4th area of managed account that's going to be focused on going back to what it really started, the end investor. It's those advice businesses that have a very, very clear segmentation of their clients as to and what they do. Very strong governance, and have to have a model that's adaptable to be able to deal with what gets thrown at them via platforms, regulators, and various other things. So if those are the priorities that need to focus on, what I've now put on the screen is what I refer to as the decision and the implementation stages. So we've got the priorities you need to focus on. What's the decision-making and the implementation that needs to take place? Now, in looking at those, I've got 2 models. There's firstly a tool, a diagnostic lens on the left, and a practical roadmap on the right. Now, one of the things and learnings that I've had over the last few years when we have looked at reviewing managed account structures is that typically when going through the decision-making process implementation, the first thing that people start looking at is the technology and the platform. Now it's thinking strategy. It's not just about the business, your strategy. Not about where you are at the moment and what's going on in your business, the future strategy and what it looks like. And these 2 tools on the screen at the moment, I think, applied to your business, and I mentioned earlier, this is a presentation all to itself, it's on the screen now. These are the lenses you need to be looking at. Does the structure support future growth and rising governance expectations? Very, very, very important. Is the operating model flexible? I said it needed to be adaptable. Is portfolio construction a core internal competency or a specialist partner's role? I think that's going to come more and more to the fore in the coming year or 2, particularly as the platforms start squeezing and tightening and the hurdle becomes bigger. Does the structure improve client outcomes while creating capacity? Does it build long-term enterprise value and reduce key person dependency? If any of those questions make you feel slightly uncomfortable, it's important that action is taken. I see I've gone a bit long, so I'll finish up on this slide quickly. From a practical roadmap perspective, importantly, assess the existing model, identify suitable cohorts, and establish governance. Partner with specialists, not specialists who understand products, specialists who actually understand advice businesses as you look ahead. And in doing this, it'll be about building the managed account model that effectively enables you to not just achieve the mission and purpose for which managed accounts were set up in the first instance, but also build the business of the future that is robust and can handle any changes that hit it. So I will stop there. Sorry, Toby, if I went on a bit long.
Questions for James. So So James, you've integrated the MDA into the platform. I mean, has that changed the way in which the platform itself is operated?
Yeah, it's been a while now. And I've only been there for 6 months. So I can't comment on what happened 6 years ago when MDAs were implementing the platform. But one thing I do know for sure that is happening right now as we work with trustees and various other things is that the hurdles and level of work involved in bringing on a new practice for managed accounts, and again, that's not a platform, it's just the way it is at the moment, is significant. So I would say less of the functionality of the platform. Trading is obviously a huge one that one's had to sort of focus on over the years. But I would say what's happening at the moment as we're working with new advice businesses is that what used to be a reasonably streamlined process in terms of getting things set up and structured and ready to go is a lot more complex and a lot more work. And that's I go back to it. Product providers find it's difficult for product providers who don't have that experience to be able to do it. You actually need to be talking to almost a business consultant and someone who deals with these day in, day out, because it's not a trivial exercise.
All right. Thanks very much.
Thanks, Toby.